The company that we are going to talk about today was founded in 1981 with a mission of bringing people and computers together successfully. 2006, this company launched into managed services in NASCOM. In 2008, British Airways entered into a multi-million pound deal with this company. In 2011, this company was ranked number one globally among IT outsourcers in the travel industry survey. In 2012, this company wins Asia's Best Employer Brand Award, acquires Sabre Philippines Development Center, and launches Crew Wings as an application for airline cabin crew members. In 2016, it wins the Aegis Graham Bell Award, the 8th edition. In 2018, this company acquires controlling interest in RuleTech 20. This company, earlier known as NIIT Technologies, was rebranded as COFORGE. Hello, folks. My name is Neil, and welcome to the 7th episode, part 1 of the Stock Market Fundamentals and Technical series. And today we are going to talk about NIIT Technologies. So let's go and take a look at the fundamentals of NIIT Technologies and see whether it's a good idea to invest in it. And I'm not going to call it NIIT Technologies anymore because it's now COFORGE Limited. Now, I've already given you a good history of COFORGE Limited. It's actually, I've not given you a full history. It's won many more awards, and it's done as one of the best employers, in the world and in the country. And as far as employees are concerned, I think it's an excellent company. So let's take a look at the other fundamentals. Screener says that the company has reduced debt. The company is almost debt-free. The company has been maintaining a healthy dividend payout of 20.31%. The only con that Screener says this company has is that the stock is trading 9.46 times its book value, which means it's a bit expensive. Now, if you've seen my previous videos, you would know that our definition of what's expensive and what's not is a little bit different. If we do a peer comparison, COFORGE, as far as market cap is concerned, stands fourth among its peers. The biggest is Mphasis. We have Oracle Financial Services, L&T Technologies ahead of it. And then we have COFORGE. If we look at the profit and loss statement, the sales revenue of the company has consistently increased over a period of time. So 914, 1232, 1576, 2323. So there was a little bit of a slowdown during March 14 and March 15, but then it picked up again. 26, 28, 29, 36, 41, and 46. So it has been growing consistently ever since. If you look at the net profits, net profits have also been growing consistently over a period of time, except a small slowdown here in 2014-15. Then it picked it up in 16, and then again a little bit of a slowdown in the profits in 17. Then it picked up again in 18, 20, 280, 403, 444, 456. So I wouldn't really, worry that much about it because even though it did slow down a little bit, it picked up immediately after that. If you look at the balance sheet, there are two things that we usually look at in the balance sheet, the liabilities and the assets. The liabilities look pretty healthy to me, if you ask me. They have been growing at a healthy pace, considering that the top line has also been increasing. The assets, however, have been growing much faster than the liabilities. So we have 824 in March 2020, and they have grown up to 3,513 in March 2021. So I don't see that to be a big issue there. The cash flows also have been healthy. So 1635 and 6137, up and down a little bit, but it's been maintained. The cash flows were excellent in March 2020. In 2021, I can see that it's a little bit low, but I wouldn't really blame them. We've seen the COVID crisis, and there are many companies that have suffered because of it. Although IT companies shouldn't have suffered that much, and I don't see that in the sales and the profit revenues. But the cash flows are a little bit affected. The return on capital is also pretty good. I would say it's above 20%, and it's been maintained over the years. It hasn't seen a big downturn or anything. It's a little bit low at this point in time, 26%. Nothing to be really worried about. The debtor days have been maintained at a healthy 70 days. It's not too much, it's not too little either. Although we looked at Britannia and Britannia maintained its debtor days at 7 days, and I said that it could be higher as well. So it's a little bit higher if you really look at it, but the pattern is healthy. It went up all the way till 93 days and 80 days also, but they brought it down to 70 days now. So that's a good sign. The shareholding pattern. This is where things get interesting. It was at 30.65% in June 2018, and then it grew up to 70% in September 2019. It's now gone down slightly to 63.99%, about 64%, which is much higher than the 30% it was in 2018. So that's a very good sign. The foreign institutional investors have reduced their stake in the company since then, but that stake has gone to promoters, which is a very, very good sign. The DIIs have also reduced their stake. I mean, initially they reduced their stake to 6.8% and 6.39% in 2020, but I can see that the stake the stakes have been improving ever since. It went up to 7.59%, 12%, and now in March 2021 it's at 11.85%. The public or the retail investors had a stake of 13.18% in June 2018, and then it has consistently been reducing over the years, which is a very, very healthy sign. So even though the promoter's stake may have, it went up to 70% and may have come down a little bit to 63.99%, what is interesting is that this stake that came down has not gone to the retail investors. It's gone down because foreign institutional investors and domestic institutional investors think that this is a good company, and they are the ones who are actually acquiring the stake from the promoters, which is a very, very healthy sign. Overall, the company is good. Let's quickly take a look at the corporate actions of this company. Now, the company has been giving out dividends on a regular basis since 2005. So almost every year, actually, and every once in a while, they've given it multiple times in a year. They've given out bonus in 2007. There was a buyback to raise money in 2020, and then no other bonuses, splits, or rights issues given. I think that there has been no bonus given since 2007, and there is potential for the company to give out bonuses anytime in the next couple of years. So overall, a very, very healthy company. I think investing in this company would be a very good idea, and for two reasons. One is that the company is quite low on risk. When the promoters think that it's a good company and want to stay invested in the company, when the institutional investors want to stay invested in the company and are increasing the stakes, it essentially means that they think that the company has a bright future. Other than that, the liquidities are good, the ratios are good, the company has maintained a healthy asset liabilities proportion, and it looks like an excellent company to invest in because it's given good growth, and the risk of this company going down is extremely low. We are going to take a look at a more detailed look at the growth of the stock price of this company when we do the technical analysis in part 2 of this 2-part video. And I do hope that you look at that video to understand the good entries and exits for long-term investors, swing traders, and intraday traders in this company. I hope you enjoy the content that I've given you. I hope you understand how fundamental analysis is done of a company to understand how risk-free or risky this company is to invest in. I'm always looking for feedback. Do let me know if you would like me to cover any ideas. Other than that, I wish us all the best, and I hope that we make a ton of money off the stock markets. Have fun. And see you in the part 2 of this video.